Good evening, everyone. Welcome to the evening classes of a very interesting topic that is presently going on, which is capital gains. Now, we had started discussing this topic in the previous class only. And I had given you this broad outline, you can say, relating to this topic so that it could create a backdrop for understanding and further discussion of this topic. So let me start from here again. As you can see on the screen, we started discussing what is income first, because only if something is income that can be taxed. Now, for being income, it has to be either a real income. And what will be a real income? A real income will be something where there is a receipt and it is earned by you. And what is earning is this, where you do something, you invest something, you give your efforts, and as a consideration, you receive something. So wherever there is consideration, that is a real income. Then we have something called as deemed incomes, where it may not be in the true sense an income, but it may be assumed by the law to be treated as income, and hence tax becomes payable. Then within receipts, we have revenue receipts, we have capital receipts. Then how to proceed with income tax law? I gave you the sequence. First, determine whether it is income, applying these rules of real income or deemed income. Then check whether it is taxable to you as per section 5, whether it fits in the concept of total income read with the concept of residential status in section 6. Check if any exemption is applicable, and if not, then your income becomes a taxable income, which as per section 14, it has to be bifurcated into one of these 5 heads. Now, which income will be classifiable under a particular head? That is determined by the charging section, which is the first section of every head. Now, our present head or the present topic is capital gains. So we will be henceforth discussing only on capital gains. Now, once you have capital gains in mind, the first thing that comes is that capital receipt would be capital gain, but that is not necessary. I have already mentioned it is not necessary that every capital receipt should be capital gain. But before that, what is a capital receipt? So wherever you receive something by sacrificing a source of income, or by transfer of a capital asset, or what is not a revenue receipt. These are the different criterions for capital receipt. Now, it is interesting to note that it is not necessary that a capital receipt would be capital gain or tax under the head capital gain only. Why? Because if you observe, except for the HP head, every other head has a reference or coverage of capital receipt. So a capital receipt can be taxed either under the salary head or the PGBP head or the present CG head or even OS. Besides this, there could be some capital receipts which are not taxable at all. Why? Because they are not classifiable as income and hence not falling under any head. That may not be taxable. This is also besides those receipts which have been specifically made exempt. So even those which have been specifically made exempt will not be taxable. And besides that, what is not covered under any head, which is not taxable, capital receipt. Then I started explaining more about capital gains chapter, where I said the capital gain head itself is an exceptional head, as you know, because all other are revenue heads. This is the only capital head. And why I'm calling it as exceptional, the other reason is, one, obviously because it is a capital head which covers only capital receipts, unlike the other heads. And main reason is this is the only head where you study a provision and you will find exception. So there will not be, I should say, any provision in this head which is not having an exception. Hence, also it is an exceptional head. Plus, all other Heads have only one charging section to determine what is covered or taxable in that head, but this head has multiple charging sections. The most common one being the main charging section of this head, that is 45(1), which has two basic requirements, that there should be a capital asset and the asset is transferred. When we dealt with verbatim this section, we identified that the requirement of this section is if there is a capital asset which is transferred, then it would be taxed in the year of transfer. And again, the charging section itself has some exceptions where if you reinvest the amount as per the provisions of section 54, there may not be any tax. Now, in order to proceed with this charging section, now what we have to see is we have to follow a sequence. And I had mentioned that we will strictly be following this sequence in the entire chapter, firstly while studying. And whenever you are handling any question, be it a practical question or a case study question, you should strictly follow this sequence. So first, check whether the two basic requirements are satisfied. One, is there a capital asset? Two, whether the capital asset is transferred. If both these are satisfied, then firstly you fall under the head of capital gains. Firstly, so to be classified under capital gains head, these two have to be satisfied. Once these two are satisfied, now check if your scenario is covered under section 10, because if it is covered, then the capital gain would be for the time being exempt from tax. If it is not covered, that is why I've written the minus sign. So first, both these things have to be satisfied. So I've put a plus sign, and this should not be there. Or excluding these cases, whatever remains is the taxable capital gain, for which now we'll proceed to do computation. But before starting with the actual working part, the first thing that you should check or analyze is in which year this capital gain would be taxed. Now, the general rule given by the charging section is it is in the year of transfer. But again, as I said, whatever you study, you will find exceptions. So there are exceptions to this also. But first, while doing computation, you determine the year of chargeability. Now, once you are in the year of chargeability, now for the working part, you require few figures or values, that is full value, expenses on transfer, cost of acquisition, cost of improvement, indexation. Now with this, you will be able to reach to the figure of capital gain or capital loss, maybe long term, maybe short term. Once you have derived that figure, and if the figure is a gain, you have been given an option by the Act to reinvest and get the benefit of not paying tax by reinvesting, which is covered under section 54. And after this adjustment is done, whatever is the balance is the final amount on which tax is payable. Then you have to check what are the rates, because there are special rates for majority of the capital gains. So this is how overall this entire chapter has to be studied. Hence, with this backdrop, we started studying the first section, or the first requirement, I should say, that is of transfer. Now, section 2 bracket 47 defines what will be covered in transfer, and it has listed down various transactions, various types of activities that would be classified as transfer, like sale, exchange, relinquishment of asset, extinguishment of rights in the asset. So here it is not extinguishment of asset, here it is relinquishment of asset per se. Whereas here it is not extinguishment of assets, it is extinguishment of rights in the asset. So this is an important point to be noted. All other activities like sale, exchange, relinquishment, compulsory acquisition, conversion of capital asset into stock in trade, all these things have to be done of the asset itself. Whereas this is the only transaction which has to be done not for the asset, but for the rights in the asset. So you have a list of different transactions which would be regarded as transfer. And then we also studied those transactions which will be not regarded as transfer. So it is like a negative list where no capital gains shall arise. Now, some important of these transactions include first, section 46(1). where a company has, at the time of liquidation, transferred, or I will say given away, or I will say distributed its assets to its shareholders. Now, these requirements are very important. All these requirements should be satisfied for this relief. First, the company is under liquidation as per the provisions of company law approved by the court. And in the course of this liquidation, instead of selling the asset outside, it has decided to give away the asset to the shareholders in return of their capital. This activity of relinquishing the asset by the company in favor of the shareholder will not be considered as transfer. It will be not taxable. However, at the same time, there is another activity happening by shareholder, that is of giving away the shares and in exchange getting this asset. Now, this second side is not given this particular shield, it is fully taxable. So shareholder giving the asset, that is the shares, back to the company, because now the company is under liquidation, hence now the shares are of no use. It is no more a capital asset or a right. Hence, the shareholder returns it back to the company. This is, however, taxable. It is covered under 46(2), which we are going to study in detail as a separate discussion point. But here, what is to be important noted is this point we are only on one side, that is company to shareholder, and not vice versa. Next, HUF. Similarly, like liquidation of company, HUF is under partition, which may be a complete partition or a partial partition. And again, because of this partition, the HUF has relinquished, given away its assets to its members. Okay, so HUF in the course of its partition has given away its assets to its shareholders, members of the family, and this is not taxed because it is not considered as a transfer as per 47(1). Next, where a capital asset is given by any individual or HF as a gift or under a will or by way of transferring it to a trust, this is also not regarded as transfer. Then holding, selling the assets to subsidiary, subsidiary selling to holding, this will not be transfer, not be taxed. Condition is it should be 100% holding, and whoever is the transferee. So here the transfer is subsidiary, here the transfer is holding. So whoever is the transferee of the transaction, that should be an Indian company. If that is the scenario, it will not be considered as transfer. One more condition, the capital asset should be given as capital asset. If you are giving capital asset and the other person is considering it as stock in trade, we will then not give this particular relief. In that case, even sale by holding to subsidiary would be taxed. It would be transfer. There is a special section 47A covering that. Then I gave you a category. That first category is the reorganization of business by way of amalgamation demerger. Here we saw multiple scenarios, but the broad two types of scenarios are covered. A company is under amalgamation or demerger, whereby the old company is selling or transferring its assets to the new company. This is generally what happens. So first benefit is in the hands of company, that this sale or transaction of transferring the assets to the new company will not be taxed. It will not be regarded as transfer. Similarly, in the same course of amalgamation demerger, there is another impact in the hands of the shareholders. What is the impact? This shareholder is the shareholder of the old company. Now, what the shareholder does, it gives away the old company shares, and in exchange, in return, it gets the new company shares. So in the hands of shareholder, there is this exchange of old versus new shares happening. Again, it will not be considered as transfer. It will not be considered as taxable if it is satisfying some conditions. What are they? So we identified the various scenarios: amalgamation of Indian company, demerger of Indian company, amalgamation of foreign company, demerger of foreign company. Here only one asset is having benefit. In all other cases, all assets are having benefit. Then amalgamation or demerger of cooperative bank, reconstitution of banks. And this scenario of relief to shareholder is provided in all the cases above, where amalgamation of Indian company has happened, demerger of Indian company has happened, or amalgamation, demerger, or reorganization of banks has happened. In all these scenarios, the transaction is not taxable because it is not regarded as transfer. Then comes business reorganization, business reconstitution cases where again different scenarios are covered. First, proprietorship converted to company, partnership converted to company, unlisted company, private company converted to LLP, or stock exchange, which was earlier acting as a AOP, is now converted to company. This is called as demutualization of stock exchange or corporatization of stock exchange. So this is in this process, again, it will be transferring all its assets and liabilities. The old stock exchange will be transferring to the new stock exchange. It is not regarded as transfer. Similarly, in this same scenario, the member of the old stock exchange who was holding membership rights will give away the membership right and in exchange will receive the shares. So this exchange of membership rights versus shares is also not regarded as transfer. So these are some of the cases. Then you have some non-resident scenarios. All these are not regarded as transfer and they are not taxable. So this is all about transfer that we studied in the previous class. Anybody has any doubts, any questions up to this point? Please put it across. We will discuss on your points and then we will proceed.
So I have a query.
Please go ahead.
Yeah, it's regarding if a builder has some unsold inventory for a period of 2 years or more than 2 years, and then he sells the asset. Is it considered as capital asset?
Okay. See, when a builder is having any land or any constructed area, the first scenario or the first question to be asked is whether it is a capital asset or a stock in trade. Now here, there are multiple judgments where the difference between a capital asset and stock in trade has been discussed. And what is coming out from all the judgments is only one thing. What was the intention at the time of purchasing or constructing or acquiring? If the intention at the time of purchasing, constructing, acquiring was to use it for your own self, it would be a capital asset. And if the intention, now this I'm talking specifically in perspective of a builder scenario. So if the intention of the builder was to either purchase or to construct that particular property with the intention of selling it, then that would be a stock in trade. So now this particular point, which is the basis, is you can say the rule which will help answer your question. Now coming to your question, if a builder has held any unsold, let us say shops or offices or flats which the builder had constructed, the general ideology is he would have constructed originally with the intention of selling it, so it remains a stock in trade. Hence, whether he sells it immediately or because let us say the market is slack, or initially he felt that let me retain it because he's forecasting that the market will grow faster or better and he will be getting good prices in the future, he may sell it after any period of time. The period of time will not determine the nature whether it is a capital asset or a stock in trade. So capital asset or stock in trade, this categorization, this classification as per the various judgment depends on your intention of acquiring it, intention of holding it. Fine, beta?
Fine. Okay, I've asked this question because if it is unsold for 2 years then it is considered as income from house property deemed income.
I know that why you asked this question, but again, if you are talking from that perspective, then you go back and read that section 23, and if I'm not wrong, it is bracket 4 or 5. It specifically says where it is held as stock in trade. So in fact, if you are specifically talking about that scenario, it is made for a stock in trade scenario only. Chalo, let us do one thing. Let us read from the Bare Act. है ना?
Okay.
So instead of making any generalization, let us read from the Bare Act itself. See, subsection 5 of 23, what it says, where the property consisting of land building is held as stock in trade. And this continues for a period of up to 2 years from the end of the year in which the construction is complete. Then up to 2 years, the gross annual value will be considered as nil. But after that, they will start taxing it by deeming it to be let out. So in fact, if you're talking about this scenario, then scenario presumes first that it is a stock in trade. So if a builder is holding any asset and the intention, as I said, firstly, the difference between capital asset and stock in trade depends upon the intention. If the intention is like, I'll give you an example of intention. So a builder is constructing a commercial project and he has decided that in that commercial project, the entire top floor, the builder will be retaining with himself for the purpose of his own corporate office. So in the same building, the entire top floor area, whatever it is, will be shown as a capital asset in his balance sheet, and all other floors, including the ground plus 1, 2, 3, whatever they are, the entire property will be shown as stock in trade. Now, assuming in this scenario, the top floor, let us say 7th floor, and 5th and 6th floor remain unsold. Now, this remains unsold for around 5 years. So, for 5 years, this 5th and 6th floor will still be called as stock in trade in his balance sheet, in his books, and the top floor will still be called as a capital asset. So, irrespective of the period of holding, as I mentioned, the intent decides what is the nature, and once it is a capital asset, irrespective of period, or once it is stock in trade, irrespective of period, it will continue to be treated as the same. Then the scenario will come that we discussed in the previous class. What this office he had constructed for his own use, now he decides to shift to another place, and now he decides that okay, now let me keep this space also for sale as my 5th and 6th floor. That is where we'll say that he has converted the capital asset into stock in trade, because now he has considered that space also like his other stock in trade. In that particular case, we will apply the case of conversion of capital asset into stock in trade. Is this clear?
Right, yes, got it. Yeah,
So
clear,
now
clear.
with this example, you can connect these different pointers also.
Right. Yes.
Fine?
Thank you. Thanks a lot.
Yeah.
Yes.
Yeah. Chalo. Now, once we have understood transfer, let me take you to the second limb of the charging section requirement. That is, there should be a capital asset which is transferred. So now we will study in detail and we discuss what is not capital asset. Again, same like transfer, you have a definition of capital asset and then you have multiple exceptions. In fact, you have exception to exception. Correct? So today, who will help me reading? Who will help me read today? Yes, Geet, please. Neha, you read last time?
Yes, sir.
Then let Geet read today first. Then maybe if he gets exhausted, we will go to you. Yes, Geet.
Yes, sir. Capital asset definition according to section 2 clause 14. Capital asset means property of any kind held by an assessee whether or not connected with his business or profession.
1 second. Now, this first part, clause A is the main definition, I will say. Other clauses are very specific and limited to a particular scenario. So the main part of the definition is clause A. But I will come to clause A later on because we need to do a lot of discussion, even the exceptions we have to study. So before that, we'll complete the remaining part, which is one of cases, specific cases covered in the other clauses. So we'll cover that and we'll come back to the discussion of A. Go ahead.
Clause B. Any securities held by a foreign institutional investor which has invested in such securities in accordance with the SEBI regulations.
Now, why this clause B is there? See, originally there was only one definition, that is clause A. Rather, it was also not clause A because when there was only one limb, there was no need of calling it as clause A. So it was only the definition read like this: capital asset means property of any kind held by the assessee, etc. Then they started identifying and adding certain specific limbs, as you can see, and now we have clause A, B, C, and so on. Now, interesting and important to notice why this limb is to be added specifically. The answer is because it was not fitting in the original part, that is today limb A. So since it was not covered and I wanted to treat it as a capital asset, I wanted to cover its income under the capital gain format. Hence, I decided to specifically add it, specifically include it in the definition as a separate limb. Now, what is this B part? For this, let me first inform you, which I'm sure you all will recall from the inter, that what is not capital asset. We have a specific list which we are going to discuss. Now, in that list, you will find that the very first item which is given as not a capital asset is stock in trade. So whatever is stock in trade, it is also your property, but a stock in trade will not be regarded as a capital asset because of the specific exclusion from this definition. Now, over a period, the government identified that if there is a foreign institutional investor, which we call as FII, who are big, let us say, like mutual funds or investment companies outside India, and they are taking or holding stakes in India because their business is investment, and to India is always a very hot market, favored market whenever investment comes because of its high returns. Now, these institutional investors, FIIs we call, regularly hold positions in India. Now, interesting and importantly, since FIIs are in the business of dealing in securities and all these types of financial instruments, so technically for them, a security which is held is like a stock in trade. And the moment you call that it is a stock in trade, the head changes, the entire computation, everything goes to PGBP. Now, what is the difference in being a PGBP head income or a capital gain head income? Broadly, I'll say two. There are multiple differences, but broadly two. One, if you recall PGBP, you will find out that under PGBP, you are allowed deduction for all expenses. Whereas under capital gain, you will get deduction only of specific expense, broadly only two. One is expenses on transfer and the other is cost of acquisition improvement. So capital gain calculation makes the calculation very specific, limited. Reason one. Two, another difference, major difference between PGBP and CG is PGBP income is always classified, categorized as a regular income, whereas capital gain head income, majorly except one, is classified as a special income. What do I mean by special income? First, it has a special tax rate. Two, it is not eligible for deduction under Chapter 6A, and then many other benefits which are available to regular income in relation to setting off, in relation to rebate, relief. Majority things are not available to special incomes. Now, the government felt, or I should say the parliament felt, that they should give a special tax treatment to the incomes which this FIIs earn in India by way of their investments. Hence, to bring them under special category, one option was making a specific clause in other sources head, because other sources you will find majority incomes are special category incomes. or incomes which are having some specific nature, which have been made tax under other sources. Or second option was to put it in capital gains. The lawmakers found it more convenient to put it in capital gain. One reason, because securities can be assets for many, like all of us, securities are assets. So it was easy to classify it as a capital gain. Also, by putting in capital gain, they could bring restriction to the computation, and also they could make a special tax rate. So considering all these reasons, they brought a specific amendment by adding this clause which says that if you are a FII and whatever securities you are holding in India, in Indian stock markets, they are actually in the nature of stock in trade, because that is your business. But we want to give it a special treatment, and hence I have mentioned here that securities which are held by you will be considered as capital asset. So whether it is stock in trade, whether it is a capital asset, now will makes no difference. For the purpose of capital gains working, it will always be regarded as a capital asset. So this is the whole reason of bringing it here and making it as a separate line item limb in this definition. Fine. Proceed. Clause C, another specific case.
Any unit linked insurance policy ULIP issued on or after 1/2/2021, to which exemption under section 10(10)(d) does not apply on account of applicability of the fourth and fifth proviso thereof.
Go ahead.
A ULIP which is issued on or after 1/2/2021, whose premium payable exceeds 2,50,000 for any of the previous years during the term of such policy, would be a capital asset, fourth proviso to section 10(10)(d).
Okay. Now what is
In
this?
case
1 second. Now we all know what is a ULIP. So originally we had pure insurance plans. Then slowly and steadily, insurance was combined with investments. And the best option that the insurance companies came out with was ULIP, which is called as unit linked. So whatever money you are putting in insurance, some part will go for your insurance and the remaining part will go for investment in mutual fund units. That is why it is ULIP, unit linked insurance plan. Now, in this, the government found that when it is a unit linked insurance plan, people are investing huge amounts in that because it was a very lucrative tax saving opportunity. Why? Because there were specific provisions which were relating to this. Firstly, there was this 10(10)(d) where it was exempt. Later on, they removed it from 10(10)(d) by putting this fourth and fifth proviso. And also, they wanted that same like the above clause B, they wanted to treat this separately, specifically as a separate item of income. Hence, they classified it in capital gains by again including this ULIP, that is a unit linked insurance policy, as a capital asset. But what is interesting to notice when you read the fourth proviso, which is reproduced here, what it says, which is issued after this date. Why this date? Because the amendment was brought after this date. And as you can see the date, it is 1st February, which is the date of presentation of budget. So in this 2021 budget, they first brought in this concept that they want to make ULIP taxable. But which ULIP? Not all. Only those ULIPs where people are investing a huge amount. It means it is a high value, high premium ULIP. Again, the logic is very simple. You will find a similar logic even in Provident Fund, RPF investments, where an employee contributes in excess of same 2.5 lakhs, and employer also contributes in excess of 2.5 lakhs. So even in salary head, you will find that there is a special type of tax treatment where even in employee Provident Fund, the stakes are exceeding 2.5 lakhs from either side. So the government felt that if anybody is investing in a year an amount in excess of that, so he or she would come in a premium class. Premium means a rich class or a top class, and we don't want them to avail this benefit. Hence, to make it taxable, they first removed it from 10(10)(d). 10(10)(d) is the exemption for all insurance policy investment returns, whatever you get on maturity of policy. 1010D gives exemption, but they have excluded it from here. And second, they have included in capital asset because, as I said, they want to give it a special tax treatment. Correct? Now, we go to some more technical details about how this 2,50,000 would be assessed, because this will be a question. Why? Because nowadays we have multiple insurance policies, some in the same company, some in the same company under the same plan, and some in different plans or in different companies. And how this 250 would be determined, that is also explained. Continue. Geet.
From fifth proviso.
No, here, na. You were here, na.
In case where the sum is payable by a person for more than one ULIP issued on or after 1 February 2021 and so not visible because of the
Okay. Huh.
and the aggregate of premium payable on such ULIPs exceed 2,50,000 for any of the previous years during the term of any such ULIPs. The exemption under section 1010D would be available in respect of any of those ULIPs at the option of the assessee whose aggregate premium payable does not exceed 2,50,000 for any of the previous years during their term. All other ULIPs would be capital assets.
So basically, fourth and fifth proviso of 1010D are only talking about ULIPs. The only difference is fifth proviso talks about how this 250 will be assessed. So very thoughtfully, while crafting this exception in exemption 1010D, the lawmakers knew that the moment you'll give a limit of 250, what people will do, they will split their policy. Let us say I have a policy where I pay premium of 20 lakhs. Example, what I will do, I will go to the company, I'll tell them make 10 policies. So I will still pay premium of 20 lakhs, but it will be per policy 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs. So this could have happened that by doing this, the people could have got out of this 250 criterion. That is why they have come up with the fifth proviso in 1010D, which says that when you have more than one ULIP, this 250 will be taken as the total of the entire premium that you pay in a financial year. Now let us say my premiums are below 250. But after adding them, they make up 20 lakhs. Now, in such cases, what does this fifth proviso says? The fifth proviso says that the exemption under this section would be available in respect of any of those ULIPs. So now what you have to do is you have to go on adding the premium of different ULIP plans until it reaches 2.5 lakhs. So out of total premium up to 2.5 lakhs premium will be exempt. Thereafter, exempt means that will not be falling in this. Thereafter, whatever policies you have where your premium in that year is exceeding 2.5 lakhs in aggregate, those policies you will classify it and you will treat it as a capital asset. I hope you understood this proviso 5. Yes. So 3 types of assets they are talking about. First is the general rule, clause A, and then 2 specific cases. One is securities held by FIIs, and second is this particular specific scenario where your premium of ULIP in a year exceeds 2.5 lakhs. Done. Now you have exceptions where what we studied above, what will be a capital asset. Now they are saying out of that, again, there is a negative list where certain items will not be considered as capital asset. Why? Same reason, I do not want to tax it. So I have put it in the negative list of capital asset. But before we go to these exceptions, let us first deliberate for a few minutes on the main provision of what is a capital asset. Now, what does the provision says? In clause A, it has defined capital asset very holistically, very widely, to say that it will be any property. Now they are saying property which may be movable, immovable, tangible, intangible, personal, or business. So property of any kind, any of these kinds, what I explained, whatever is the nature of the property, once it is a property, it may be intangible, makes no difference. It may be something which is movable or immovable, makes no difference. It may be your personal, makes no difference. It may be a property or asset held under the name of your business, makes no difference. So far as it is a property and you are holding it, we will consider it as an asset. Now, this main part of the definition is so holistic, so wide that everything under the sun, whatever is your property, will be a capital asset. And hence, they have then given this negative list where some of these items will not be a capital asset. Why? Because they don't want to tax it. Start reading.
However, it does not include first stock in trade, any stock in trade other than securities specified to in B above, consumables, consumable stores or raw materials held for the purpose of the business or profession of the assessee.
Okay. So first part says that what we are not going to consider in stock in trade is, in capital asset is stock in trade, except item B above, that is securities held by FII, because that I specifically included because I want to cover it as stock as a capital asset. So I have specifically included it by making a separate clause B. So that is excluded from this exception. It means only one type of stock in trade will be treated as capital asset, that is the securities which is held by FII. Correct? Then it says whether a particular asset is stock in trade or capital asset does not depend upon the nature, but the manner in which the same is held. This was the exact point we were discussing. So, what was your intention of acquiring it? That will determine whether that item is a capital asset or a stock in trade. And it will not be decided by the nature. Like if somebody is holding a building or a piece of land or a plot of land, you cannot say that every plot of land will always be a capital asset, or a building or a flat in a building will always be a capital asset. No, it will depend upon the manner in which you are holding it. That is your intention. So where a builder is holding it, it may be treated as stock in trade in the hands of builder. But where a person like me holds it, it will be treated as a capital asset. Again, in the hands of builder, if the intention of the builder of holding that was for his own use and consumption, it could still become a capital asset and not a stock in trade. The items would be stock in trade in the hands of the assessee who deals or trades in them. However, the same item would be capital asset for the assessee who holds it as an investment. So this is just a generic explanation. Now this part is important. Read this box.
The exclusion of stock in trade from the definition of capital asset is only in respect of subclause A above and not subclause B. This implies that even if the nature of such securities in the hands of the foreign portfolio investor is stock in trade, the same would be treated as a capital asset and the profit on transfer would be taxable as capital gains. Further, the explanatory memorandum to the Finance number 2 Bill 2014 clarifies that the income arising from transfer of such security by a foreign portfolio investor would be in the nature of capital gain irrespective of the presence or otherwise in India of the fund manager managing the investments of the assessee.
Okay. So this explanation is pretty straightforward. What I wanted you all, or I wanted to bring to light is this. Do you all know what is a memorandum to a finance bill? Anybody knows what is a memorandum?
Yes, it gives the explanation of the finance bill. It's just, I think it's an explanation, complete explanation of the provisions of the finance bill.
Correct. It gives explanation, it gives justification of why that amendment is proposed in the finance bill. So finance bill is your budget. One of the components of budget is the finance bill. And the finance bill, which is bringing about many changes, has to justify or give the reason for those changing. That is what is the memorandum. What is this finance bill number 2?
It is the second bill introduced in the year.
In the throughout year, whatever are the number of bills, this is the second number of bill throughout the year.
It would be, I think it would be in the finance, Ministry of Finance. I don't know actually. I think.
That is why I'm asking, because these are some very important points that you should know as a professional. The answer is, if you see 2014, correct? Then 2019, and then last year, 2024. These are election years. Now, in all election years, you'll find that budget is twice. One, before the election, which is on the fixed date of 1st February, you have your budget, which is fixed, which is called as a pre-election budget. Now, generally, since it is not known who would be in the power after the elections, hence, the first budget is always considered as a temporary budget. You can say that, though it is not actually temporary, that is also passed and implemented. But major changes are not announced by any government in that, because they want to see firstly the election results. And the moment the election happens and the results come, whether or not the same party is continuing in power, they again have other session immediately after the results are declared. The first session itself of the parliament is for bringing the next finance bill. That is where you will find that there are two finance bills in the year of budget. Hence, the second one is called as finance bill number 2. So it is not in the total year the second bill, but it is specifically the finance bill which is the second bill. Had it been the sequence, like what you were saying, like I'll give you an example. When in 2016 the constitution was to be amended to bring in GST, the constitution amendment bill till this date was the 122nd number bill. So that was the sequence. So till now, from your independence 1950, that is from the date the constitution was brought into existence till date, there were 122 times the constitution amendment proposals brought in the parliament. So where they want to give the number as the sequence number, it always precedes the name. So if they want to say that this is the second bill of the whole year, then the word will be before. So it is, they will call it as the second finance bill. But if they are saying finance in bracket 2, it means they are only specifically talking about finance bill, which has come in the year 2014 only. This is the second finance bill coming in the same year. That is why it is said finance into bracket number 2. And this will find happen only in the election years. So after that, if you see 2015, 16, 17, 18, no such number 2 you'll find out. Again, you'll find this in 2019. Again, nothing in 20, 21, 22, 23. Then again in 2024. Even this year, which is 25, you have only one finance bill. There is no finance bill number 2. Fine. So the first exception to asset is capital asset, means a capital asset is not taxed. A stock in trade is not a capital asset. Hence, it will not be taxed under the head capital gain. It will be taxed if it is sold because it will become a PGBP income, but it will not be taxed under the head capital gains. Second exception or second thing which is not regarded as a capital asset is personal items. Now, this is the second clause which is very important. And important why? Because firstly, because of the generic definition, everything under the sun, whatever is your property, would be taxed or would become a capital asset and would be taxed whenever you are selling it. However, the lawmaker are sensitive enough and they are mindful enough to understand that you as a human being require certain daily items or something in your property which would be your basic necessities of life. So they have decided to exclude these basic necessities. Now, these may not only be basic, this may be now even comforts, but they wanted to exclude whatever you are using in your individual capacity, in your personal capacity. Now, what is important is you are even using your house as an individual in your personal capacity. And in fact, it is one of the basic necessities also, but that is not excluded. It is very much a capital asset. Why? Because this particular condition of personal effects not being treated as capital asset has this qualification that it should be movable. So only movable personal items will not be regarded as capital asset. Hence, your flat in which you stay, which is a personal effect, but it will be a capital asset also. Correct? Now, this point has some exclusions, as you can see, means these items which you see in the exclusions, even if they are your personal assets, they will be capital asset and they would be liable to be taxed under this head only. Because they are exclusions to personal effect, it means they become capital assets. Yes, please read.
Personal effects. Personal effects, that is to say, movable property, including wearing apparel and furniture held for personal use by the assessee or any member of his family dependent on him.
Now, very
Exclusions.
important is they are not limiting personal effect only to your own use. So even if something is held by you for the entire family's use, like one thing they have already mentioned, that is furniture. Another thing which I'll mention is all your kitchen equipments, everything in your kitchen, or I'll say everything in your house. Even the refrigerator, that is one of the equipments that is there in your house, that will also not be a capital asset because of this condition that personal effects which are movable will not be a capital asset. So anything in your house will not be a capital asset. Importantly, the vehicles which you are using, the laptops, the mobile phones that you are using, everything is not a capital asset because everything is your personal effect. But important to note in this space, if the same laptop, if the same motor car is purchased by you in your business name and you are showing this as an asset in the balance sheet of your business, then the same item will be considered as a capital asset. So this benefit of not being regarded as a capital asset is applicable only when it is held in your personal name, in your personal capacity. But if the same asset is held in your business name, let us say you have a proprietary firm and you have shown the laptop bill, the mobile bill, means the purchase bills in your business as a expenditure over there, and it is appearing in your balance sheet, you are carrying that particular thing as an asset of the business. We will not give you this shield. Tomorrow, whenever that is sold, it will be coming under capital gain only. Right? Now read the exclusions.
Exclusions. Jewelry, archaeological collections, drawings, paintings, sculptures, or any work of art.
Now, what is a jewelry? This is also defined because at times there could be confusion about what is and what is not a jewelry. Please read.
Jewelry is a capital asset, and the profits or gains arising from the transfer of jewelry held for personal use are chargeable to tax under the head capital gains. For this purpose, the expression jewelry includes the following: ornaments made of gold, silver, platinum, or any other precious metal, or any alloy containing one or more of such precious metals, whether or not containing any precious or semi precious stones, and whether or not worked or sewn into any wearing apparel. Second, precious or semi precious stones, whether or not set in any furniture, utensil, or other article, or worked or sewn into any wearing apparel.
Great. Now let me give you some examples. You have to say yes or no. For yes, you can type Y. For no, you can say N. Now, my first question is that let us say you have a diamond necklace. Is it a capital asset? Or let us not go to capital asset. Is it a jewelry? Because if it is a jewelry, even though it is personal use, it will be capital asset. No, let us not do capital asset. Let us only be up to jewelry. Is it a jewelry? Diamond necklace. You have to simply type Y or N. Chalo, great. Now let us say, like if you remember, so not remember, if you have seen or heard, the old time Raja Maharajas or their family members, the dresses that they used to wear would have been made, let us say, out of gold thread, or many times they used to have some weaving work which included your motis, different types of pearls. Whether that dress, or let us say the mukut that they were wearing with some very heavy diamond piece in that, whether that is jewelry, that mukut, that let us say any of their dress, sari, is a jewelry. Great. Next question. You have a small stool in your house. That stool is I'll change the example. You have a silver this plate, a silver small vati, what we say, bowl, a silver spoon, a silver glass. Whether this is jewelry. Okay, Chitra says no. But others are saying yes. Chitra says no. Others are yes. All other answers were yes by all. Only in this answer, for the first time, we have got conflict because Chitra is saying no. The silver plate, bowl, glass is not a jewelry. Chitra, would you like to give any explanation for the same?
Because they say they're ornaments, and silver bowl is not considered as an ornament.
But have they not covered utensil over here?
But those are about precious or semi precious stones which are embedded in any furniture or utensil.
Okay, okay. So go ahead.
And about that sari, I mean, you said that wearing apparel too. I have doubt about that. I said yes, but I think it's no.
Why?
Because it's not separately considered here.
It
You
is
can't
considered.
consider the gold thread as an ornament.
But see, now it is specifically considered here. No?
Diamond can be considered, but gold threads.
So what will be covered in this? See, ornaments made of gold, silver, etc., whether or not worked or sewn into a wearing apparel.
But they didn't say metal exactly. They are saying ornaments. That's what I'm
So,
having doubts about.
so that is why I'm in fact, I'm also raising this very important question. Now, I think you are guided by this word ornament, correct?
Yes.
What is your definition of the word ornament?
A piece of jewelry, a piece of something you can wear separately.
Correct. Means you are classifying it with one of the items that we normally wear as jewelry, correct? Like a
Yes.
bangle or a earring or something, correct?
Yes.
Chalo, let us see what the boss says. Correct, no? And for us, everyone, at least not for me, but for many of you all, the read this, beta. Chitra.
A thing used or serving to make something look more attractive, but usually having no practical purpose, especially a small object such as a figurine.
Interestingly, have they anywhere used the word or any such indication what you were trying to say? Like you meant by ornament something for wearing, right?
Yes.
They have not used that meaning at all. Are you getting my
Yes.
point?
Yes.
They are saying anything the purpose of which is to make someone or something look more attractive. That's it.
Okay. Means in any form.
Exactly.
Okay.
See, all other definitions also. Now, this is again interesting. The accessories of worship. Interesting. Now, even in our households, if you are having a small temple or some place where you keep God, you have small things which are made out of gold and silver. Like whatever things you are using as an accessories for worshipping. Correct now? We use small that ghanti we use so many things which are our worship accessories. You understand this?
Yes.
Even they are ornaments.
Okay.
So ornament has a more holistic meaning beyond what we have or we visualize that is only something which is necklace or nose ring or earrings or bangles. It is beyond that. Ornaments are not limited to any of these wearing items only. They are definitely covered, but it is not only this. Are you getting this? So even a piece of cloth will be an ornament. Like as I was saying, if something is made with gold thread, acha. Now it is not that only Rajas and Maharajas were doing it. Even we are using it. Like I don't know what you all call it. In our language, we call it as odna. So during rituals, especially married females, they use one dupatta type of a thing, which is generally of red color. But on that, we have some work done using silver thread, which is also called as zari. You all have seen that? We call it as odna. So in all rituals and all functions, wherever we have like marriages or there is a birth of a child, so there is some ceremony going on, or there is any puja, we we means the married females they put that particular red colored dupatta which we call as odna. Yes, Neha knows that she is Agarwal, na? Okay. So in many places, even today, we have these cloths where we are using silver or gold thread for weaving and making some design or something on it. So even that is an ornament. So it is not necessary an ornament is limited only to any of these bangles. In fact, I'll go a step further. Nowadays, even specs come of golden frame. That is ornaments. We have all these cuffling buttons, tie pins. Nowadays, if you want, you can have it of gold, silver. You have your pens, wrist watches with gold plating. Sorry, in fact, the entire watch itself is of gold. Depending upon the person who wears it, he or she has his budget, and you have gold watches, pure gold watches, right? Or watches which has in its dial some gold parts like the needles would be of gold, the numbers would be with diamonds. So there are so many things. All these things may not be fitting in the very the meaning of what we understand ornament as, but they are all ornaments. Why? Because they are used for making someone or something look more attractive. And even your accessories of worships that we use in our mandir at home for various our rituals, it will also be ornament. Understood, beta? Chitra?
Yes, sir.
So first answering your previous question that can wearing apparel be jewelry? Yes. Now coming to the main question from where we started discussion, there what you said, I 100% agree. Utensils made out of silver is not jewelry. And that is where if you sell that silver utensil, it will not be taxed. Provided see why we are reading the definition of jewelry, because we were discussing personal effects and jewelry is exception to personal effects. Now if something is not your personal effect in the first place, anyways, it is a capital asset, then no need to discuss about that silver plate or whatever. But if something is your personal effect, then it will not be a capital asset. But if it is fitting in the definition of jewelry, it will become a capital asset. Now, coming back to this utensils, you will find that again in our households, generally for various rituals, for various this puja and all these things, we have silver made utensils. In fact, in different cultures, for different occasions, even you eat in the silver utensils. Even something is cooked in the silver utensil. Like in our tradition, we normally say that when the first food bite is given to a child, it is given in silver spoon. That is why there is a saying which goes saying that a person is born with silver spoon. Means what? That they are so rich that they can afford to go feed their child using silver utensils. So that is where silver utensils are personal effects. So first is silver utensils are personal effect. Yes. Are they jewelry? Answer is C. Here I agree to your answer. What you said, silver utensils are not jewelry. Why not? Because utensils are considered as jewelry only in point 2, not in point 1. And in point 2, in order to be considered as a jewelry, the specific requirement is that there should be some precious or semi-precious stone which is put there. Here, when you are reading ornaments made of gold, silver, here there was no reference of utensils because utensils could be made of gold, silver. But where the utensils are for your personal use, they will not be considered as an asset. They will also not be fitting in the definition of jewelry, because for fitting in the definition of jewelry, utensils get covered only in point 2. Furniture utensils are such things which are getting covered in point 2. So if there is a small furniture item, like I was talking about this when I changed the example because I felt utensil is much easier to discuss. So like again for our rituals, we have small chowki, which is made up of silver. We have small that pata, which is made up of silver. Why? Because again for different rituals, different pujas, we use that silver made chowki or pata on which either we stand and do the puja, we sit and do the puja, or we place the god on that and we do the puja. Again, that furniture, if it is made up of silver, it will not be taxed. Why? Because it is not jewelry. So furniture utensils made of silver or gold, if they are in your personal use, they are not jewelry. Now here, there were multiple judgments where one of the judgment even discussed on this, but are you using that silver utensil daily? The answer is no. We use it occasionally. Then what? For that, again, the Honorable Supreme Court said that it makes no difference whether you are using it daily or not. Again, here, they went by the intention theory. If your intent of holding is to be used as a personal effect, even though occasionally, it will still be regarded as a personal item and it will not be a jewelry. So it is not necessary that you use the silver utensil daily, only then it will be personal effect. No, it can be personal effect even if that item is used occasionally. In fact, your gold ornaments, many of them are used occasionally. Still, they are personal effects. That is a different thing that they are getting covered in jewelry, so they will become taxable, but still they come in personal effects. Similarly, if you have any of these utensils or furniture made of gold, silver, which you actually use, though occasionally, that will be personal effect and it will be eligible for this benefit of not being taxed. Now, follow up to this, there was another case where a person had 50 set of silver utensils, 50 sets. Now came up again a question that this could be a tax evasion measure, that now once you know that silver utensil will not be considered as a capital asset, then let us do one thing. Instead of buying and keeping silver bars or something which is in the ornament form, let us keep it in the utensil form. Anyways, whenever we sell it, we will get profit because of price rise and there will be no tax. Why? Because we will claim it to be personal effect. And there were decisions by then stating that it is a personal item, irrespective of whether you are using it once or regularly. So when this matter came up, then Honorable Supreme Court again gave one more logic. What was that logic? Or I should say, what was that test? That it said that whenever the law says personal effects, it means which could be legitimately put to personal use. What is legitimate? There also the Honorable Supreme Court said that whether 50 set of utensils could be considered as for personal effect legitimately, that depends upon certain factors. One, size of your family. Two, your social status, social standing. Three, your cultural beliefs, followings. All these things will decide how much of this quantity could be legitimately personal effects. Whatever is excess, surplus, will not be considered as personal effect, and hence you don't even require to come to the definition of jewelry, because the moment it is not a personal effect, it is anyways a capital asset and it would be taxed. So this is how this entire concept around silver gold utensils has developed till date. I hope this entire pointer, whatever I tried to explain and discuss, is very clear to everyone. Anybody has any doubts with this further?
No, clear.
Perfect. Let us go to the next exception, which is about agricultural land, which is in rural area. So if you are having agricultural land in rural area, that is again not considered as an asset. So if you sell it, there will be no capital gains. Please read.
Rural agricultural land in India, that is agricultural land in India which is not situated in any specified area. As per the definition, that only rural agricultural lands in India are excluded from the purview of the term capital asset. Hence, urban agricultural lands constitute capital assets. Accordingly, the agricultural land described in A and B below, being land situated within the specified urban limits, would fall within the definition of capital assets, and transfer of such land would attract capital gain tax.
Now, for the purpose of this point, they have said that if agricultural land is in specified area, and what is this specified area? For simplicity, we are calling it as rural area. So if the agricultural land is in rural area, it would be not taxed because it would not be a capital asset. But if it is in any other area, it would be a capital asset. Now, what is a rural area? This is again very important, because again, we have some generic understanding. Like whenever you go to your native place, you say that, where are you going? I'm going to Gaon. Like in Hindi or Marathi, we say Mama ka Gaon, Mama's a Gaon. But that may not be a Gaon, because for a person like me, my native place is Mumbai. I'm born, brought up Mumbai. My entire family is in Mumbai. Let us say I shift to some other place and now I'm visiting to my hometown or my birthplace. As per generic language will say, where are you going? By you are going to your native. But native does not necessarily means that it is Gaon. Though originally we used to refer to native places because it was a Gaon, because everybody belonged to a smaller place originally and shifted to a bigger place for the purpose of work. Now, law has been very specific that it says that only what is covered in these two A and B parameters, anyone, that will only be a rural area and that will be eligible for this benefit if your agriculture land is here. Now, there are 2 points to be understood. One, what are these areas where it is, what areas are covered in A and B? Two, what is agriculture land? Now, again, here, an important point to be understood and discussed is that whether the land should be actually used for doing agriculture presently. So one is, it could be an agriculture land as per the land records, but presently it is unused. You're not doing any agriculture. Like many times it happens that originally, traditionally, you all were having agriculture as one of your professions. Later on, the family started migrating to urban places, and now you all are shifted and completely staying in urban place, but you still hold that agricultural land. Maybe it is kept idle. So the question is whether it could still fall in this section and be benefited. Answer is yes. In this section, there is no requirement that the land should be actually used for agriculture purposes. Even if it is kept idle, not being used, or you have given it on rent to someone who is doing agriculture, in all these cases, it will still be called as an agricultural land. But when you go further, there are furthermore sections in the same chapter where some benefits are attached to agricultural land. In those sections, there is a specific requirement that the land is used as agriculture for some minimum 2 years, 3 years period to get the benefit of that section. Then over there, the answer would depend upon the actual usage. But in this part of the section where we are understanding what is and what is not capital asset, there is no requirement of the actual usage. So whether or not it is actually used for agriculture, still it continues to remain as an agricultural land. Fine. Now let us understand what areas are rural. Please read A.
A. Agricultural land situated in any area within the jurisdiction of a municipality or cantonment board having population of not less than 10,000 or
Okay. So one, the area that we are talking about is an area which is not coming, mark my words, which is not coming in a municipality or a cantonment board, because municipality and cantonment boards are all urban places. So in order to be rural, that area should be coming under Gram Panchayat. So the jurisdictional authority over there should be Gram Panchayat, because if it is municipality or cantonment board, it will be an urban area. Same point has another condition, having a population of not less than 10,000. So in order to be classified as urban, because A and B, what we are studying, students, please understand, it is a definition of urban indirectly, right? So what is urban is area which is having municipality as their local government and whose population is above 10,000, where the area is such that it is not covered by municipality, it will be rural, or which is covered by municipality, but having a population of less than 10,000 will also be rural. So for rural, clause A has two criteria. One, either it should not be under municipality or cantonment board jurisdiction, it is urban. Sorry, it is rural. Second, even if it is having a municipality, but the population is below 10,000. In both these cases, the area would be considered as rural. Correct? There, if you have an agricultural land, it will not be a capital asset. But when that agricultural land will be a capital asset, if your area is a municipality and the population of your area is above 10,000. Fine? Okay. Go to B.
B. Agricultural land situated in any area within such distance measured aerially in relation to the range of population as shown hereunder.
Now, this B clause was added for a simple reason. So let us say the place where you are staying is very much fitting in A. So wherever all of us stay is very much fitting in A. In such a case, our proper area, which is covered by municipality, is urban, no doubt. But the moment you get outside your area, many times we find that when we leave our city limits to travel somewhere, you will find a board that, okay, thank you very much. The municipal corporation area ends here. Now, the question is the area where the municipal corporation limit ends, whether immediately after that, the entire area will be considered as rural. Answer is no, because clause B extends the urban part even beyond the municipal boundaries. So up to A point, only the municipal boundary or the area under the municipal boundary is urban, but B extends that area further. How much further? It says where the population is more than 10,000 but less than 1 lakh, up to 2 kilometers. Where the population is more than 1 lakh but less than 10 lakhs, up to 6 kilometers. And where the population is more than 10 lakhs, up to 8 kilometers. Now, what is this? So, the point where your city's municipal limit ends, beyond that, up to 2 kilometers or up to 6 kilometers or up to 8 kilometers area will still be considered as urban. How much of this will depend upon the population of your city. So if your city's population is between 10,000 to 1 lakh, beyond your city limits up to 2 kilometers is urban. If your city's population is above 1 lakh but up to 10 lakhs, then up to 6 kilometers beyond your city limits will be urban. And if your city's population is above 10 lakhs, then up to 8 kilometers after your city limit ends, that 8-kilometer area or the 8-kilometer radius, I should say, is also urban. This is what is the point in point B. So here they have given different case scenarios to determine whether the asset is situated in an urban area or a rural area, and hence accordingly whether it will be classified as a capital asset or not. Is this clear to all? Please read the explanation.
Explanation regarding gains arising on the transfer of urban agricultural land. Explanation 1 to section 2 1a clarifies that capital gains arising from transfer of any agricultural land situated in any non-rural area, as explained above, will not constitute agricultural revenue within the meaning of section 2 1a.
Now what is 2.1a? Do you all know? What is 2.1a? Anybody knows? 2.1a is the definition of agriculture income. Now, the very first exemption that we have under section 10 bracket 1 is for agriculture income. Now, there was a lot of dispute about what is and what is not agriculture income. Hence, the lawmaker in section 2, which is the definition section, decided to define agriculture income by inserting clause 1a. So that is how you have section 2 clause 1a, which defines what will be agriculture income. First point. Now, whatever is agriculture income, we all know it is exempt. Now the question comes, what if you have an agriculture land which is in urban area? Now we all said that once agriculture land is there, if it is an urban area, it will be a capital asset, means the sale of that land should become a taxable capital gain. However, there could be a cross question then. Will it not get exempt under 10.1? Because 10.1 exempts agriculture income, and since you are saying this is agriculture land, even if it is an urban area, the sale of that land should lead to agriculture income only, and then it should get exempt under 10.1. Hence, a specific explanation is inserted in the definition of agriculture income, which is under section 2 clause 1a, which clarifies that whatever capital gain you will get by selling this agriculture land, and we are talking only about urban. Why? Because rural anyways it is not income in the first place, so no discussion required. But if your agriculture land is in urban area, whatever capital gains you will get by selling this agriculture land, that will not be considered as agriculture income as per 2.1a. In other words, it will not be exempted under 10.1, because had it been agriculture income, it would have got exempt under 10.1. So they have specifically mentioned that whenever you are selling agriculture land, we will not consider it as an exempt income. It will not be considered as an agriculture income. Correct? So in other words, capital gains arising from transfer of such urban agriculture land will not be treated as agriculture income for the purpose of 10.1, and hence it will continue to be taxable under section 45, that is capital gains. Please go ahead, Beda.
7% gold bonds 1980 or National Defense Gold Bonds 1980 issued by the central government. Special bearer bonds issued under Gold Monetization Scheme 2015 and Gold Monetization Scheme 2018 notified by the central government.
Now see, all these are the different bonds of government, as you can see from the name, which the government wants to promote. And the best way of promoting is making their income exempt. So they want more and more people to invest in these bonds so that the money also goes to government, and these gold bonds were introduced so that people stop buying physical gold and unnecessarily creating pressure on our foreign reserves and on our foreign policies. Hence, they brought this particular type of relaxation that you buy these gold bonds, and whenever you sell it, obviously it is an asset, there should be capital gain. but we are excluding it from capital asset itself, hence there will be no capital gain. Correct? Now, they have given a note, property includes and shall be deemed to have always included rights in or relation to an Indian company, including rights of management control. So property includes all types of asset, physical, non-physical, etc., etc. This is a summary of,
does this also include sovereign gold bonds?
No, but for sovereign gold bonds, you have a separate relaxation separately. Sovereign gold bonds are not covered. Now, once you come to the definition of capital asset and you decide that, okay, your property is a capital asset, the next step is to determine what type of capital asset it is. Now, we all know that capital gain head says that there could be two types of gains or losses. Now, actually, there is no two types of gains or losses. It is actually two types of assets. If the asset is long term, the gain loss will be long term. If the asset is short term, the gain loss would be short. So basically, it is two types of assets. Now, when an asset is long term and when the asset is short term, again, the general rule, keeping aside the exceptions we will see, depends upon the period of holding. Now, when you are talking about the financial year 24-25, if that is your previous year, it means your assessment year is 25-26, which is presently going on, then for you, this chapter is going to create some problems, especially with respect to determining whether the asset is long-term, short-term. Why? Because in this 24-25, which was again the budget year, and post your elections, when you had the second budget, which was the was brought in capital gains. You will find the first glimpse here and further glimpses as we move ahead. What is that major amendment? First amendment is that if you are selling the asset after this date, that is 23rd of July 24, then for determining period of holding, this rule takes place if the transfer has taken place before this date. And if you have transferred the asset after this date, then for determining long-term, short-term, this is the rule. Now, in both the cases, whether it is before or after this date, the capital gain, long-term, short-term, is dependent upon the period for which you have held the asset. So the period of holding, the period for which you had, you were having the control of the asset, that is the deciding criterion. Now, as you can see, the old rules, now I'm calling it as old rules, before applicable for assets transferred before this date, there were 3 time periods, 12 months, 24 months, 36 months. However, the new rule has only 2 time periods, 12 months and 24 months. So as per the new rule, your asset would become long-term either after 12 months, that is 1 year, or after 24 months, that is 2 years maximum. So this condition of 3 years has now been removed, and you have only this rule of 1 or 2 years, right? I'm just reading this, making you all read the second part. First part you all can read. Please read the second part.
In case transfer takes place on or after 23/7/2024, security listed in a recognized stock exchange, including listed units of a business trust, unit of equity oriented fund, unit of UTI, zero coupon bonds, less than 12 months
Less than or equal to. See, when you have this underlined type of a thing, so this is less than or equal to.
Less than or equal to 12 months immediately preceding the date of its transfer.
Will be short term. So when it will be short term, if your period of holding of these assets is exactly 12 months, correct? And for all other assets. So you can see, interestingly, for, I should say, financial instruments like listed securities. Now, what will come in securities? Shares, debentures, bonds. All these are securities. So if these are listed, it becomes long term after 12 months. If they are unlisted, it becomes long term after 24 months. But if you are talking about units of mutual funds, now broadly mutual funds can be two types: equity oriented, debt oriented. Equity oriented mutual funds will become long term after 12 months, but the debt oriented mutual fund units will become long term after 24 months. And besides this, if you have zero coupon bond, it will become long term after 12 months. So you have to remember this, that as per this new rule, these financial instruments will become long term after 12 months. And other than these financial instruments, all other assets. Now, when I say all other, it will mean unlisted shares, unlisted bonds, debentures. Second, it will mean all assets like motor vehicles, jewelry, land, building, laptop, computers. All these assets will become long term after 2 years. Earlier, these assets, which I just named, like laptop, computers, motor car, jewelry, they all became long term after 36 months. Land, building, and unlisted shares became long term after 24 months, that is 2 years. And listed securities and units of equity oriented fund, zero coupon bonds, they became long term after 12 months. So you can say this part has more or less remained unchanged. That is this 12 months part. What has majorly changed is the 24 and 36 months part. So earlier in 24 months, you had only two assets. Now all assets other than the these three items of financial instruments, other than this, all assets are in the 24 months rule. I hope this is clear to everyone. Go ahead with the note.
As per section 50AA, capital gains arising from the transfer of the following assets would always be capital gains arising from the transfer of short-term capital assets, irrespective of the period of holding of such assets.
Okay.
Units of a
Okay, please read.
Units of a specified mutual fund acquired on or after 1/4/23, market-linked debentures, unlisted bond, and unlisted debentures, which is transferred or redeemed or matures on or after 23/7/2020.
So, what is the point? Now, as I said, every provision that you read has an exception. Now, we were till now saying that, okay, depending upon period of holding, you will decide long term, short term. Now, this rule has an exception in section 50AA, which says that for these three assets, you will never calculate, or you are not required to calculate the period of holding. Why? Because the transfer of these three assets will always give rise to short-term capital gains only. So for these three assets, you need not look at the period of holding, because the gains or losses, whatever, arising from these assets would always be classified, would always be considered as short term. Is this clear to all? Then they have defined what is equity oriented mutual fund, what is a zero coupon bond. I'm not getting into all that. Now this is an important circular. Please read.
Applicability of tax on capital gains in the hands of the unit holders, where the term of the units of mutual funds under the fixed maturity plans has been extended. Circular number 6 2015, dated 9/4/15. Fixed maturity plans (FMPs) are closed-ended funds having a fixed maturity date wherein the duration of investment is decided upfront. Some asset management companies (AMCs) administering mutual funds have offered extension of the duration of the FMPs by providing to the investor an option of rollover of FMPs in accordance with the provision of Regulation 33A of the SEBI Mutual Funds Regulation 1996. The CBDT has vide the circular clarified that the rollover in accordance with the aforesaid regulation will not amount to transfer, as the scheme remains the same.
Now what is this?
Accordingly,
I'll tell you. Now you purchased or you invested in a mutual fund plan, which gave you a fixed period, let us say 2 years. Now Now, after 2 years, they said that we are giving you an opportunity to roll over. Now, we all understand what is rollover, that you can continue this same plan. How you can continue the same plan? That you can extend it by rolling it over. So means what was supposed to end today, if you roll over, you'll get 2 more years in this. So your plan will continue for 2 more years. Now in this particular case, when you are saying that your plan will continue again, it is as good as that this plan is over. You are selling this units and getting the fresh units of the second plan, which is again for 2 years. However, the CBDT clarified that since the scheme remains same, hence we do not want the tax again. So where you are rolling over, so technically it may appear that old units are sold and in that place new units are bought, but we will not consider it like that. We will consider this rollover as not transfer. So there will be no capital gain liability arising. This is fine. Now comes the next part. Determination of period of holding. Now, what is this period of holding determination? As you can see here, the long-term, short-term classification purely depends upon the period for which you held the asset. Now, this period, just pay attention, is from here to here. So the period of holding is from here to here. Now, what is this period of holding? Generally, the period of holding starts with the date on which you acquire the asset and it ends on the date immediately prior to the date of transfer. So in short, we do not count it up to the date of transfer, that you can see here also. In definition also, they are specifically saying immediately preceding the date of transfer. So first you understand how do you count period of holding. The general rule is from here, this is the date of acquisition. From that date to a day prior to the date of transfer. This period is your period of holding. Now, what does this explanation is talking about? So we are studying section 2 bracket 42A, which is the definition of short-term asset. Section 2 bracket 29A is the definition of long-term asset, which is very simple. What is not short-term is long-term. This is defined in 229A. And what is short-term is what we just saw above, depending upon the period of holding. If the period of holding is equal to or less than 12 or 24 months, it is short-term. This is what is given in 242A. Now, we have this part of 242A, which is trying to clarify how will you count this period of holding. So as I said, the general rule is period of holding will start from the date of acquisition and it will end 1 day prior to the date of transfer. However, this rule has some clarifications, or I should say some special scenarios and some exceptions. What are some clarifications? So this is the general rule. Starting from the date of acquiring till 1 day prior to the date of transfer. This gap is your period of holding. Now in this, what are the case scenarios? First, shares held in a company which is under liquidation. So you are having shares of a company. Let us say you acquired it on 1st January 2024. Fine. In October 24, the completion and which is sanctioned, which is approved by the court. So from October, the company is under liquidation. Now we all know that a company under liquidation, there is an entire procedure in the Companies Act where the liquidator will be appointed, the liquidator will notify government and all and then start liquidating the asset and equity shareholder. So your chance comes now in the month of September 2025. You return your shares and you get the money. Now these shares are assets, yes. You have given to the company has paid you. So there is capital gain, yes. However, the question is whether it is long-term or short-term. Now we just saw above, if the shares are listed, it is 12 months. If the shares are unlisted, it is 24 months. So that is also clear. But the challenge is from where to where I have to count. Our original rule is from the date of acquisition till 1 day prior to the date of transfer. This is our general rule. However, this rule has this first exception, we say we will not count it up till today. we will count it only up till October 24. So for determining whether these shares are long-term, short-term, from 1st January 24, which is the date of your acquisition, till let us say 31st of October holding, because this explanation says the period subsequent to the date of liquidation. That is, in my example, after October, the company is under liquidation. If we counted from year to year, it will be counted from year to year. So from the date of acquisition till 31st of October will be counted. Remaining further period till the time you will get the money, that is all excluded. Correct? Now, I have left out in between cases. Why? Because over there I have a generic rule for you that will come. Now, what is point number 5? Where shares or any other security subscribed by the assessee on the basis of right to subscribe. In short, the company has given you right to purchase the right shares. So you all know that again company law says that whenever the company is bringing another issue, it has to first offer it to its existing shareholders, which is called as a right or right issue. Now, the question is, you are already holding some shares in the company. Let me call them as original shares. And now you are getting the right shares. Now, we are not talking about original shares. We are only talking about right shares. The question is, or the doubt was, how to calculate the period of holding of this right shares. Whether it will be counted from today, that is a date when you purchase, you subscribe for this right shares, or it will go backward from the date when you have the original shares. So it has been clarified that the period of holding for right shares will be counted from today, because the original shares and the right shares are two different assets. They may be of the same company, but every share is a separate asset, because you may sell the share separately. So the period of holding for right shares will be counted from today. That is the date from which you are allotted the right shares, and it will not include the period of previous shares or the original shares. Similarly, before you apply for right shares, you are given the right to purchase these right shares. In fact, if you remember your accounts, even you have the option or opportunity to sell the rights. You can even sell the rights without buying the right shares. So even this right is an asset. So what is the period of holding of this right? It says it will start from the date, will be counted from the date on which you are given the right. Now, where any financial asset is allotted without any payment and on the basis of holding of any other asset. Now, what is this? Now, this is, if you remember, we had some no transfer cases. So whatever I'm leaving in between, all these are relating to those no transfer cases. Why I'm leaving it? Because I'm going to give you one single rule which will cover all these which I'm leaving right now. Okay, all are dealing with that one single rule which I'm going to give you as a golden rule. Okay, only this 18 is different. So what is 18? Where specified security or sweat equity shares are allotted. Now we all know, if you're an employee of a company, the company may allot you some of its shares free of cost or at a very low price as sweat equity shares. The question is, from which date the period of holding will be counted? Again, the rule is simple. The period will be counted from the date of allotment. So you are given these equity shares, maybe because you have served under this country for 10 years, but it has no connection with this 10 years. Since equity shares or sweat equity shares are altogether a new property, the date of allotment will be considered for the purpose of counting period of holding. Fine. So these 2-3 scenarios which I just explained are some specific scenarios. Now, whatever I have left out, I'll give you a golden rule, and that one golden rule will cover all those cases, right? But that now we'll cover after the break. Let us have a 15 minutes break. We have been speaking, or I have been speaking for around quarter to 2 hours at a stretch, and it would be too much overloaded for you all also. So we take a break, we reconnect after 15 minutes, and then I'll give you that golden rule also. Fine. quick reference in future. So this could be your ready handmade notes. So what is capital asset? It is defined in 2 clause 14 as property of any kind which is held by the assessee, and exceptions majorly are personal effects, rural and agricultural, and in some specified bonds. However, within personal effect, jewelry and so many things are a capital asset. That is, they are not an exception. Now, capital asset may be short term or long term. 229A defines what is a long term capital asset, which is simply not a short term capital asset. That is how the definition goes. So what is the key definition is of short term? But just before I give you the definition, there is 242B and 229B. 242B defines what is short term capital gain, which says gain or loss arising from transfer of a short term capital asset is a short term gain. And then accordingly, 229B defines what would be a long term capital gain, which is defined as any gain or loss arising from transfer of a long-term capital asset. Fine. Now, what is a short-term asset? Now here, we have to see date of transfer of the capital asset. Correct? And the deciding is 23rd of July 24. After and up to. Here there are 3 answers. "12 months, 24 months, 36 months." And after this date, there are only 2 answers. Correct? So this is how short-term capital asset has been defined. Now this whole concept depends on your period of holding. Explanation 1 to section 242A. Now what is this explanation 1 to 242A saying? That period of holding is from here to here. What is this? This is your date of acquisition, purchase. And this is what? This is 1 day prior to the date of transfer. So this is the period of holding. Correct? Now, this has some exceptions or special cases. Shares in a company under liquidation, right shares, ESOPs, and rights. For this period of holding starts from date of allotment. This period of holding excludes period from liquidation. Now, I left out many clauses in between. Now I'm going to give you a golden rule. What is that golden rule? Where any asset is acquired where any asset is acquired in one of the, one second, let me use a color for this. Where any asset is acquired by one of the modes which is not regarded as transfer. So the rule which I'm going to explain is based on this point, that you have acquired the asset in one of the modes which is not regarded as transfer. Then, one second. Now, when any asset is acquired by you, how? In one of the modes which is not a transfer, which we already studied in the definition of transfer, then period of holding will be counted from previous owner. Now, what do I mean by this? Let me explain. Till now, I was saying period of holding is from here to here. Correct? Now, this period I was saying is your period of holding. Right? This is the original rule which I gave you here also. Date of acquisition purchase. Now, here you have acquired in one of the modes which is not a transfer. So, how? You have been gifted this asset by your father. Now, you acquired the asset on this date, right? But what we are going to discuss is what I have called as golden rule 1. Why I call this as golden rule? Because this one rule covers 30 plus sections or 30 plus scenarios. And I really mean it, 30 plus scenarios, out of which 10 are here in this one point only. That is what is period of holding. Now, what is the rule? Till now, my period of holding was starting from the date when you acquired the asset. Now, in such scenarios, now what is my point? Where any asset is acquired by one of the modes which is not a transfer. So I'm giving an example. How did you acquire the asset? You did not purchase the asset. You got the asset under gift, under will made by your father. Now all these scenarios of gift will are not regarded as transfer. So for you, the period of holding will be counted from previous owner. So now your period of holding will be this to this. So even this period will now be included in your period of holding. I hope you understood this point, students. Now, this one rule covers, as I said, 30 plus scenarios, out of which 10 are covered in this table itself. What is the rule? You have to just recall all the scenarios which is not regarded as transfer. In all those scenarios, the period of holding is counted from the date of previous owner. Is this fine? Now, let me take you to these scenarios. One we discussed, let me take you to second. Where asset becomes a property of an assessee by virtue of 49.1. What does 49.1 covers? Gift, will, holding subsidiary, amalgamation, demerger. All these cases are covered in 49.1. The period for which the asset was held by the previous owner shall be included. So you will count it from the previous date. Correct? Next, where shares in the Indian amalgamated company becomes a property of the assessee in lieu of shares held by him in the amalgamating company. So same case. You were having shares of old company, you gave the shares of old company, you got the shares of new company. Now for counting the period of holding of new company shares, you will count it from the date of previous company shares, that is the old company shares. So what is given? The period for which the share was held by the assessee in the old company is to be included. Correct? Now this rights shares we discussed. Right? This point is where financial asset allotted without any payment. And this is what? This is bonus shares. Again, bonus shares, right shares, they are all considered from the original date. That is the date when you have been allotted those shares. So here I will just add bonus shares also. So bonus shares, right shares, ESOPs, for which the period of holding is, the period of holding starts from the date on which these shares are allotted. Fine. Now, coming back to our golden rule scenarios. Next, where shares in the Indian company being a resulting company becomes a property of an assessee in consideration of demerger. So now, again, what has happened? In the case of demerger, you had old shares, you gave the shares of old company, you got the shares of new company. The period of shares, the period for which the shares were held by the assessee in the old company shall be included. So again, your period of holding starts from the previous date. That is the date of the previous shares. Next, where trading or clearing rights of a recognized stock exchange in India is acquired by a person pursuant to demutualization or corporatization of stock exchange. So again, it is the case of not transfer. Old stock exchange converted into new stock exchange. Mutual fund, AOP stock exchange converted into company stock exchange. Now, in this case, what has happened? In the hands of the the broker, he was having membership right and the trading right in the old stock exchange. This has got converted for the shares in the new stock exchange. Now, the question is, from where will the period of holding be counted? So it says the period for which the person was member of the recognized stock exchange immediately prior to such demutualization shall be included. So we'll count it from the previous date, that is before the demutualization. From that date, it will be included. Next, where equity shares is allotted pursuant to demutualization, again, the period for which the person was member of the recognized stock exchange immediately prior to demutualization shall be included. So the period of holding of shares in the new stock exchange will be counted from the membership of the old stock exchange. So again, the previous period is included. Next, where units of business trust allotted pursuant to transfer of shares as referred to in 47. Referred to in 47 means it is not transfer. Again, the period for which the shares were held by the assessee, previous shares, will be included. Why? Because here, in exchange of shares, you are given units. Now, for these units, the period of holding is counted from the date of purchase of original shares. Next, where units became the property of the assessee in consideration of transfer of units in the scheme, which is of consolidation of mutual fund, again in 47.1, again the previous scheme's period is included. Shares of a company is acquired by a non-resident on redemption of GDRs referred to in this section. Now, if you remember, this is not the case of not transfer. Hence, for this, the rule is different. The period from the date on which the request for redemption was made shall be reckoned. So it is from the current date. Why? Because this is not a scenario of not transfer. Next, where equity share in a company becomes a property of the assessee by way of conversion of preference share to equity shares. Again, converting debentures to shares, or preference share to equity shares, all these are not transfer. So again, for this, what is the rule? The period for which the previous asset or bonds was held by you, that is to be included. So again, your period is counted from the previous date, where the unit becomes the property of the assessee in consideration of transfer unit in the consolidated plan. Again, the period of previous plan is included. In case of units or units in a segregated portfolio referred in this section, again, this is not a section of not transfer. It is not of 47, it is of 49. Hence, it is saying it will be counted from the current date. So as you will see, the golden rule which I have given, where does the golden rule applies? It applies only in cases of 47, which is not transfer. And in all those cases, the rule is the period is counted from the date of previous owner or previous asset. I hope students you got this point. So wherever you will have this case which is covered in 47, the period of the previous asset is also included while counting period of holding. The period of previous owner is also included in counting period of holding. So coming back to our rule, golden rule. Now I'm sure you'll be able to understand, remember, and even apply it very easily. So all the cases of not transfer is put in one rule. So where you are acquiring the asset by one of the modes of not transfer, then period of holding will be counted from previous owner. I will add one more word, previous asset. So where asset is converted from some previous asset to new asset, the period of holding of new asset is counted from previous asset. And where you are acquiring the asset from some previous owner, like in case of gift, will, inheritance, or holding to subsidiary, or all those cases, the period of previous owner is also counted. So now your period of holding starts from here by including the period of previous person. I hope this is clear. This is the golden rule and this is not yet over. I will come back to this golden rule when we are discussing some future point of this chapter. We will come back to this golden rule. So this is all about the point of capital asset period of holding. Period of holding in respect of other capital assets, the period for which any capital asset is held by the assessee shall be determined in accordance with rules made by the CBDT. Accordingly, the CBDT has inserted Rule 8AA in the rules to provide for method of determination of period of holding other than capital assets which are mentioned above. Please read from here below.
In the case of a capital asset being a share or debenture of a company which becomes the property of the assessee in the circumstances mentioned in section 47(10), there shall be included the period for which the bond, debenture, debenture stock, or deposit certificate, as the case may be, was held by the assessee prior to the conversion.
Same golden rule. Which scenario? 4710, when bond gets converted to shares. Again, what it is saying, the period of the previous bond will be included while counting the shares period of holding. So now you are having shares which are acquired today, but the period of holding is counted from the previous bond date. Go ahead.
Section 4710 provides that any transfer by way of conversion of bonds or debentures, debenture stock, or deposit certificates in any form of a company into shares or debenture of that company shall not be regarded as transfer for the purpose of levy of capital gains tax.
Go ahead.
In case of a capital asset which became the property of the Indian subsidiary company in consequence to conversion of a branch of a foreign company referred to in section 115JG1, the period for which the asset was held by the said branch of the foreign company and by the previous owner, if any, who has acquired the capital asset by a mode of acquisition referred to in clause 1, 2, 3, 4 of section 49(1) or section 115JG1 shall be included.
Again, what is this case? Where the capital asset becomes a property of Indian subsidiary. Why? Because of conversion of some foreign companies as referred to in 115JG. Now, what is this that I'm not dealing with right now? We study that in detail in the taxation of non-resident. Yes, go ahead.
In case of the amount which is chargeable to tax as income of specified entity under section 45(4) under the head capital gains, the amount or a part of it shall be deemed to be from transfer of short-term capital asset or long-term capital asset, as the case may be, mentioned in column 2 if it is attributable to the capital asset mentioned in corresponding row in column 3.
Now, what is this? It is saying deemed capital gain from transfer of capital asset. Now, capital gain from transfer of a short-term capital asset. Now, what is the type of capital asset of specified entity? This is what is mentioned. Now, what it means is capital gain is arising from transfer of short-term capital asset. What is that capital asset? The capital asset which is short-term capital asset at the time of taxation of amount under section 45(4), or capital asset forming part of block, or capital asset being self-generated asset and self-generated goodwill as defined in 45(4). Now, what it is trying to say that deemed capital gain from transfer of capital asset. So basically what we are studying in this particular table is that we are going to study a specific case under 45(4). Now, if your amount is chargeable to income tax under section 45(4), what is that? That we will cover very soon. It is the case where partnership gives away the asset to its partners. Then the question is, what will be the treatment? So I just said, in case of the amount which is chargeable to tax as income, specified entity under 45(4). What is 45(4)? Partnership firm is giving asset to the partners. Under the head capital gain, the amount or part of it shall be deemed to be transfer of short-term capital gain. Shall be deemed to be transfer of short-term capital asset or long-term capital asset, as the case may be, mentioned in column 2 if it is attributable to capital asset mentioned in corresponding row in column 3. Now, what it is trying to say, if the capital gain is arising from one of these assets which are mentioned in column 3, correct, then they shall be deemed to be capital gain from transfer of a short-term capital asset. Now, why this is the case? It means the transfer or the capital gain arising from transfer of these 3 types of capital asset will be considered as capital gain from short-term, and capital asset which is not covered above and is long-term capital asset at the time will be obviously considered as capital gain from long-term. So basically, the second point according to me is not important. What is important is the first point, that the transfer of these 3 capital asset will be treated as a capital gain from transfer of short-term capital asset. In short, in these 3 cases, the taxability would be as if it is a short-term capital gain. First, the capital asset is a short-term, no problem at all. Short-term will be capital gain, short-term only, no problem. What is important is this. Capital asset forming part of a block of asset. I am sure by now you all know what is a block of asset. So whenever you have income from business, you have to compute depreciation, and for computing depreciation, you make blocks. Now, whenever you make block of assets, that is, you combine the assets and make one category, one block, then whenever there is a capital gain on this block, the capital gain is always treated as short term. Now, the same thing they are mentioning over here, whenever the same type of capital gain will arise under 45(4). What is 45(4)? 45(4) is wherever there is transfer by firm to partner. Now, wherever there is transfer by firm to partner, this is a specific scenario covered in 45(4). Now, in such cases, the capital gain is in the hands of the firm. We are going to discuss that special case when we come to 45(4). But for the time being, what they are trying to clarify over here is that for such assets, we don't look at period of holding. In such cases, compulsorily, the capital gain will be deemed to be capital gain from short-term asset. In other words, it will be a short-term capital gain. One, where the asset itself is short-term, okay. But where the asset is part of block of assets, remember this rule, students, any capital gain or loss arising from block of assets transfer will always be considered as short-term. Similarly, capital asset is what? Self-generated asset. Now, we all know what are self-generated assets. Like they have one case of self-generated goodwill. Then you have self-generated assets which are like patents, copyrights. These are all self-generated. You may also buy it from someone, but let us say you have created your own patent, your own copyright. So all these capital assets will also be treated as short-term. So Just remember that whenever there is transfer from firm to partner, these two, I should say, because this is anyway short-term asset, these two will also be regarded as short-term for the purpose of computation. Just for the time being, remember this. You will understand this mathematically also, that is computation-wise also, when we'll study 45.4 in detail. So, students, this is all about asset. Right? Now, we come back to our charging section from where we started. Now, we discussed one of the charging sections, which was the main charging section, or rather, which is the main charging section, which is 45.1. Now, if you remember, I had mentioned that there are more than one charging sections. The second charging section is this section 45 bracket 1A. Now, why I am saying this is another charging section? Because the scenario which is covered over here was originally not covered by 45.1. And because of a Supreme Court judgment, the lawmakers decided to introduce this. So I'll first tell you the gist or the background of this. Now, what is this scenario? As you can see from the heading insurance receipt, I'll ask you to read this. Now, what is this? I'll give you a real life example to explain. Now, let us say there is some type of a fire in a factory, because of which the machinery, the building, everything is converted to ashes. It means it is completely destroyed. It has been converted to ash. Fortunately, you have taken an insurance policy. So against building, you get 5 crore rupees. Against plant and machinery, you get 2.5 crore rupees. Now, before the section 45.1A was there, means when it was not there, people were under the impression that, okay, if I have received any insurance claim, there has to be a tax, because in general, it is a presumption by everyone, even today, that whenever any money comes to you, there has to be a tax. But there is no such thing. I've been mentioning you have to first check if it is income, whether real or deemed, but it has to be income that is falling into 24. If it is not falling in the definition of income, any receipt which does not satisfy the condition of income cannot be taxed. Now, the point is that before this 45.1A, people were assuming that even in case of insurance, that is where my assets are destroyed, there should be a tax because I'm receiving some insurance claim. And they were taxing it under 45.1 only. However, there happened a landmark judgment where this point of the definition of transfer was highlighted. What is the definition of transfer saying? It says extinguishment of rights in the capital asset. Very important point. It is not saying extinguishment of capital asset. It is saying extinguishment of rights in the capital asset. I have been emphasizing this right from our first part when we started discussing this. Now it is saying the section which defines transfer does not say extinguishment of asset is transfer. It is not saying that. And logically also, please understand, if my asset is destroyed, it is turned to ash, where is a transfer? Because see, for transfer, I have to do some act myself of giving the asset to you in some form. Now here there is no asset. You are the insurance company. Yes, you are paying me the 7.5 crores, 5 crores towards building, 2.5 crores towards the plant and machinery. But what have I given to you? Have I given to you the asset? The answer is no. Never. Because the asset is not in existence. Now, did I extinguish the asset? Answer is no. Even I did not extinguish the asset. And let us say for any stretch of imagination, if anybody is interpreting this to be extinguishment of asset, still the court said there will be no transfer, because transfer will arise only when there is extinguishment of rights in the asset, not the asset itself. It means the judgment said that for destruction of asset, there can be no transfer. And no transfer means no capital gains under 45.1. This is how the courts landed up saying, boss, you don't have to pay any tax in case where there is destruction of asset, and even though there is some insurance money coming. The moment this decision was out, the lawmaker felt that, okay, this point we left out. Now they had a choice of one, changing the definition of transfer to include this scenario also. But then, very logically, I believe very appropriately, they decided not to amend the definition of transfer. Why? Because had they amended the definition of transfer, the problem would have been that now transfer includes something where there is actually no transfer. Nobody is giving to you anything. The asset was there. It automatically means because of some fire, etc., it got destroyed. But I did not do any action. I am not giving anything of the asset to you. Now the asset is not there. It is completely zero. So I should not logically include it in transfer, because logically also nothing is going from one person to another. Hence, in their proper wisdom, they decided to bring a parallel charging section in the form of 45(1)(a), which says that wherever you receive the insurance money, and the insurance money is received, why? Because there is some damage or destruction of asset because of one of these reasons. Then, now see the language. Why this is a charging section? See the language. Then, any profits or gains arising from receipt of such money or other assets shall be chargeable under the head capital gain. Same like the language of 45(1). That is why I'm saying this is a parallel charging section, because it is using a similar language what 45(1) used. But for this one particular case scenario, what is a case scenario? There is some destruction of asset. Why, or sorry, not why, how the destruction has happened, for what reasons it has happened. It has happened on account of flood, typhoon, hurricane, cyclone, earthquake, etc., or because of some riots, or because of some accidental fire or explosion, or because there was some action by an enemy. Like we saw, we had some attacks from some Pakistan and all, and let us say some drone or some missile came and landed at your factory in Kashmir, and it got destroyed. So that is what is action by enemy, or action taken in combating an enemy. Now we also responded. We carried out the entire Operation Sindoor. Now many times it happens that when you are taking action, one of your missiles get misfired and it lands in your place. So these things happen. These are collateral damages. So if any of destruction of the asset has happened even in this scenario, and it has clearly said with or without declaration of war. We did not declare any war with Pakistan this time. So it may be with or without declaration of war, but there is some action with some enemy, which may be a country, which may be a person. Then whatever profits or gain arise from receipt of such money shall be chargeable to tax under the head capital gain. And interestingly, it shall be deemed to be the income of the person of the previous year in which the money was received. Now, interestingly, this rule becomes exception to, first, it is another charging section. Second, it is becoming exception to this rule. Which rule? The rule relating to what was the rule? Year of chargeability. It is year of transfer. However, we have exception. 45(1)(a). In case of 45(1)(a), year of chargeability is year of receipt of insurance claim. So this rule, which was given in 45(1), has been breached, or an exception is created in 45(1)(a). It says we will tax you only when you receive the insurance claim. So for other normal cases of transfer, the transfer happens in the year, the taxability happens in the year of transfer, whether or not money is received. But this is the first exception where taxability happens in some other year, which is the year of receiving the insurance claim. So we were talking about charging section 45(1)(a). Now you have the next charging section 45(1), which deals with insurance claim on account of destruction of capital asset. And then it has given some case scenarios: fire, flood, hurricane, enemy action, etc. Is this clear to you all, students? So this is a parallel charging section 45(1)(a). Correct? Now you have the next parallel charging section 45(1)(b). Please read.
Unit linked insurance policy receipts. Section 45(1)(b), where any person receives at any time during any previous year any amount, including the amount allocated by way of bonus on such policy under a unit linked insurance policy ULIP issued on or after 1 Feb 2021, to which exemption under section 10(10)(d) does not apply on account of the applicability of the fourth and fifth provisos thereof, then any profits or gains arising from receipts of such amount by such person shall be chargeable to income tax under the head capital gains, and shall be deemed to be the income of such person of the previous year in which such amount was received.
Go ahead.
Any ULIP which is issued or after 1 Feb 21, whose premium payable exceeds 2,50,000 for any of the previous year during the term of such policy, would be a capital asset. Fourth proviso to section 10(10)(d). In case where premium is payable by a person for more than one ULIP issued on or after 1 Feb 21, and the aggregate of premium payable on such ULIPs exceed 2,50,000 for any of the previous year during the term of any such ULIPs, the exemption under section 10(10)(d) would be available in respect of any of those ULIPs at the option of the assessee whose aggregate premium payable does not exceed 2,50,000 of any of the previous year during their term. Fifth
So this
proviso
part is
to
what we have said it. Yes. Read. This part is important.
Thus, the amount received under any other ULIPs issued on or after 1 Feb 21, referred to as specified ULIPs, to which exemption under section 10(10)(d) does not apply on account of applicability of the fourth and fifth proviso thereof, would be taxable under section 45(1)(b). The income from such ULIPs taxable is to be calculated in such manner as may be prescribed.
So this becomes your third charging section, which is 45(1)(b), which deals with what? ULIPs, or I'll say specified ULIP. Specified means exceeding 250 premium. So specified ULIP, what they have used, amount received. So against the specified ULIP, any amount is received, it is considered as a capital gain. Means this is again making it taxable. And again, interestingly, this is the second exception to the rule of year of transfer, which again makes it taxable in the year of receipt of ULIP money. So the second exception to this rule of year of chargeability, it is not taxable in the year of transfer, but taxable in the year of the receipt of this ULIP amount. Now, how to compute the capital gains on this ULIP, that the section said would be prescribed. And whenever in any act, whenever the word used prescribed is used, we should know it is prescribed by the rules. Now we have this special rule, Rule 880, which has given you the manner of computing the capital gains whenever amount is received under ULIP. Now please understand, students, why this special rule is to be given. Now in ULIP, what is happening? You are investing money in the insurance policy. Now we all know insurance policy is towards insuring your life. And in this particular case, since it is a ULIP, some part of your insurance amount, that is a premium amount, is also going towards investment in units. Now, in this particular case, how to find out capital gain, that is provided in the rule. Let us understand. Please read.
Accordingly, Rule 8AD prescribes the following manner to compute capital gains on receipt of amount under such specified ULIPs, where any person receives at any time during any previous year any amount under such specified ULIPs, including the amount allocated by way of bonus on such policy, then, where the amount is received for the first time under such specified ULIP during the previous year. A minus B, where A equal to the amount received for the first time under such specified ULIP during the previous year, including the amount allocated by way of bonus on such specified ULIP, and B is the the aggregate of the premium paid during the term of such specified ULIP till the date of receipt of the amount as referred to in A.
So now what is this? How much would be capital gain depends upon the situation. The first situation is amount is received for the first time. So what type of ULIP policy is there? Your policy is such that you will be receiving amount at some periodic intervals. Now, first amount is received. In such case, capital gain arising from this amount received will be calculated as A minus B. What is A? It is simple. The amount received for the first time under the specified ULIP. Again, what is specified ULIP? Exceeding 2,50,000, that you should keep in mind. Where the premium, exceeded 2,50,000. Now, the amount received also includes the amount allocated by way of bonus. Now, I'm sure you all would be knowing, whenever you take a life insurance, many times the life insurance policy may be with or without bonus. What is this bonus? If the insurance company is earning profits, then some portion of the profits they have to allocate to their policy holders. That profit allocation by the insurance company to the policy holders is called as bonus. Now, your policy may be with bonus or without bonus. That makes no difference. So it has clarified, including the amount allocated by way of bonus. Now, that is A. So in short, A is the amount received. What is B? The aggregate of premium paid during the term of such specified ULIP till the date of the receipt of the amount. So if you observe, the calculation A minus B is very simple logical thing. I cannot write on this, but it is simply the amount received minus the amount invested till date. Simple. So you have been paying premium every year. Let us say every year your premium is 3 lakh rupees and till date you have paid 30 lakh rupees. Now you are receiving 42 lakhs today. So 42 lakhs is A, 30 lakhs which is the aggregate premium paid till date minus. So 12 lakhs is your capital gains. This is when you are receiving the first amount, correct? Let us go ahead. Please go ahead.
Where the amount is received under such specified ULIP during the previous year at any time after the receipt of the amount as referred to in 1. C minus D, where C equal to the amount received under such specified ULIP during the previous year at any time after the receipt of the amount as referred to in 1 above, including the amount allocated by way of bonus on such policy. Note, the amount which has already been considered for calculation of taxable amount during the earlier previous years would not be included in C. D equal to the aggregate of the premium paid during the term of such specified ULIP till the date of receipt of the amount as referred to in C as reduced by B. That is the premium that has already been considered for calculation of taxable amount during the earlier previous years.
Now, I hope you would have understood this. Now, what does the second situation cover? In the same policy, I am receiving amount again. So as I said, your policy may be such where you may be receiving amount periodically. Now, when I received the first amount, which was my first case, I said, let us say after 10 years, you receive 42 lakhs. So 42 lakhs was A. And in 10 years, per year, 3 lakhs, I have invested 30 lakhs. So 30 lakhs is B. So 42 minus 30, 12 lakhs is my capital gain. Now, after further 5 years, so after that 10, again 5 years have passed. And after 5 years, I receive one more amount. Now, this amount is 18 lakhs. Correct. Now we want to decide how much is capital gain for this second payment. The answer is C minus D, where C is this 18 lakhs. What is this 18 lakhs? 18 lakhs is my second installment. And you should note in the note, they have already mentioned that what you received earlier, 42 lakhs, you should not consider it here. So 18, that is exclusively the amount received second time is C. What is D? D is whatever premium I have paid after the first receipt till this date. So my first receipt was after 10 years. The second receipt is after further 5 years. So whatever premium I have paid in this 5 years is D. Now every year again 3 lakhs. So 5 into 3, 15 lakhs. So 15 lakhs is the amount which is D, which is the aggregate of premium paid till date, till the date of receipt of this amount as reduced by B. So they are saying aggregate premium for all 15 years minus the first 10 years. I have directly taken for the next 5 years. So it is 15 lakhs. And what was C? C was the amount which I have received for the second time, that is 18 lakhs. So 18 minus 15, 3 lakhs is the capital gains. Now what is very important is capital gain as computed above would be deemed to be capital gain arising from transfer of units of equity oriented fund set up under the scheme of an insurance company comprising unit linked insurance policies. So they are saying the tax treatment of this will be as if it is transfer of a unit of equity oriented fund. So the tax treatment will be same like equity oriented fund. So even though this is an insurance policy, insurance plan, but the treatment of this will be like as if you have sold the units of equity oriented fund. Geet is asking, is there a reason for adding ULIP in definition of capital asset when income from ULIP is already included in charging section 45(1)(b)? Geet, in order to include it in 45(1)(b), first it has to be called as a capital asset. That is why they brought this as a amendment in the definition of capital asset to first make it a capital asset and then to include it in the charging section 45(1)(b). Correct? So both are complementary, both amendments took place together, and without both the amendments, you could not have taxed it. So first I have to call it as a capital asset. Otherwise, it is your investment in some policy. So the question is whether the policy is a capital asset. So they have clarified, yes, it is a capital asset. And then second, 45(1)(b) is a parallel charging section saying that now you will not see whether transfer has happened or not. We don't want to see transfer. Simply, whatever the insurance company is regularly paying you the amount, assume there is a transfer. See why this is required 45(1)(b), because actually you are not surrendering your policy. The policy is ongoing, but you are receiving amount in between after periodic intervals. Where is there is a transfer? No transfer. Hence, you require 45(1)(b), which is a parallel charging section. It says that even though there is no transfer, but we have firstly assumed this policy to be a capital asset. So first thing we have satisfied. Second, we have brought 45(1)(b) to deem this as a capital gain even without there being a transfer because the policy is ongoing. Still, I want to tax it. So I am bringing 45(1)(b), which now has no requirement of transfer. Correct? Yes. Perfect. Now we come to another special case scenario, which is 45(2). Now we already read about this in transfer, that converting capital asset into stock in trade will be considered as transfer. Now we are going to study that how is this capital gain to be computed, right? So for this, I'll give you one simple example to explain you this 45(2), what it says. Now, what does 45(2) deals with? It deals with conversion of capital asset into. Now, this is already a transfer as per the definition of transfer. Okay. Now, what is special is, let me give you an example. You had purchased a plot of land, let us say on 1st January 2006. Now, this was purchased as an investment. So, obviously, it is your capital asset. Then, on 1st January 2000, let us say 16, you started a new business of dealing in properties and you decided to consider this as stock in trade. So as I had explained this at the time of previous class when we were discussing transfer and this point had come of conversion of capital asset into stock in trade. I said, what exactly you do? You do nothing. Only in books, you change the category from asset to stock in trade or from fixed asset to current asset. So what I did is in my balance sheet on this date, I removed it from fixed asset and I put it in current asset. This is the only thing I did. Now, when I did this, as per this section 45.2, read with the definition of transfer, there is a capital gain which is attracted. However, interestingly, even though this date transfer has happened, but there is no tax to be paid on this date. The tax will be paid when this stock in trade land is actually sold. And let us say it is sold on 4th of January 2025. Now let us say some timelines. So this is 20 lakhs, the cost. On the date of its conversion to stock in trade, that is the date when I considered it as stock in trade, I converted the capital asset into stock in trade. The FMV is rupees 5 crores. And today I'm selling it for rupees 5.5 crores. Correct. Now, whenever you are talking about land building, there is always a question of stamp duty value. Now, this is your purchase price, correct? That is your actual purchase price. So I'll just put stamp duty value, 22 lakhs. Here, on the date on which you convert into stock in trade, again, you have some stamp duty value, rupees 6 crore. And the date when you sold, see, this is your sale price. Again, here you have stamp duty value, 6. Now, let us go step by step. When you purchase this asset in 2006 for 20 lakhs, the stamp duty value was 22 lakhs. It is of no relevance to us. The year in which you converted the stock in trade, converted the capital asset into stock in trade, this value is of no relevance. Section 45.2 says, for us, the relevant value is the FMV for computing capital gains. And interestingly, now today, when you are actually selling it, now this is being sold as stock in trade. So the treatment of this will go to PGB. So I'll show you the computation. Now we are dealing with previous year, 24-25, our last year. And current year is the assessment year. That is the year in which I am filing my returns. Now with respect to this transaction, I have two incomes. One is the PGBP income, which is for sale of this stock in trade land, which has happened here. My PGBP income is my sale price minus something. Now here I sold it for 5.5 crores, but there is some stamp duty value. Now whenever the stamp duty value is exceeding your agreement value by more than 10%, and it is exceeding, as you can see. Now here, the sale price will be determined by section 43CA. This you would have studied in the PGBP chapter. Now the sale price will become 6.75 crores, which is the stamp duty value. And why I'm considering? Because even if I add 10% to this, the amount will be 6.05 crores.
6.05.
Your stamp duty value is exceeding that 110%. Since it is exceeding the 110%, hence, as per 43CA, the sale price would be this. Correct? Minus. Now, what I will take minus is the FMV on date of conversion. What was my FMV? 5 crores. So My PGBP head is showing income of 1.75 crores. B, capital gain. Now this capital gain is arising on account of conversion of capital asset to stock in trade. Now, how do you compute capital gain? It is FPC minus index cost of acquisition because this asset is long term. Now, importantly, this capital gain on account of conversion is calculated as per the section which we are discussing, that is 45.2. What does 45.2 says? Whenever there is conversion which took place in this year, right? Firstly, the conversion is transfer, yes. What will be the full value? Full value will be only FMV. Here, stamp duty value rule is not applicable. Stamp duty value rule is applicable only when you are selling it. And from this, I have to deduct my cost of acquisition, which is 20 lakhs, but I will have to index it. So I will index this 20 lakhs. Now for this, I'll multiply it by the stamp value of the year of transfer, which is this year, 15-16. I don't know right now. We have the indexation table. And I divided by the stamp duty value of this year, which is 5.6. So I get some index cost. For the timing, I'm just assuming for the sake of computation, it is coming as 60 lakhs. That is 0.6 crores. So 4.4 crores is my long-term capital gain. So what you understand from this example is that whenever there is conversion of a capital asset into stock in trade, 45.2 is triggered. Firstly, it says that there will be no tax in the year of transfer. What is the year of transfer? The year of transfer is the year of conversion. But it says we don't tax you in this year. We will tax you only when it is actually sold. Now, when it is sold, two incomes are triggered because what you are selling today is SIT. So PGP is triggered. And this capital gain on conversion, which was pending to be taxed, both are taxed together. Now, in order to avoid double taxation, this FVC, that is full value of consideration, is what? It is nothing but your FMV. So here FMV becomes your sale value and the original cost is your cost. This is how you compute capital gain. Now, since you have already considered this FMV here as your sale value, the same FMV here becomes the cost for computing your PGBP income. So by taking this same FMV as cost here, you are avoiding double taxation. So for this head capital gain, the FMV is my sale value. And for this head PGBP, the same FMV becomes the cost, so that you are not facing double taxation challenges. This is what is given in 45(2). Can you please read, beta?
Conversion or treatment of a capital asset as stock in trade, section 45(2). A person who is the owner of a capital asset may convert the same or treat it as stock in trade of the business carried on by him. As noted above, the conversion treatment is a transfer. As per section 45(2), notwithstanding anything contained in section 45(1), being the charging section, the profits or gains arising from the above conversion or treatment will be chargeable to income tax as his income of the previous year in which such stock in trade is sold or otherwise transferred by him. Full value of consideration. In order to compute the capital gains, the fair market value of the asset on the date of such conversion or treatment shall be deemed to be the full value of consideration received as a result of the transfer of the capital asset.
So what is important is, in this case, 2 points to be noted. First, the full value for the computation is the fair market value on the date of conversion, and the tax would be paid not in the year of conversion, but in the year in which this stock in trade asset is actually getting sold. So this is what is the working which I showed you just now, taking some values, some figures. And note, both capital gain and business income are chargeable to tax in the same year. That is the current year in which the stock in trade is sold. So this also becomes my exception again to this rule of year of chargeability. So next exception is 45(2). In case of conversion of capital asset into stock in trade, it is the year of sale of SIT, not the year of conversion. So see, the general rule for year of chargeability was year of transfer, but it has so many, you can say, exceptions or special cases. Fine, students. So we have completed asset, we have completed transfer. Now we are in different special provisions of computation of capital gains. So that's it all from my side for today. I hope you all understood whatever we discussed today. I try to give you the basis, the logics of each and every provision, each and every section that we are studying, so that it is easier for you to retain and recall in future. So with this, thank you all. Thank you very, very much. Let us meet again for the further special case scenarios in this topic. Thank you all.
Yeah, thank you, sir. Thank you.
Most welcome.
Thank you, sir.
Thank you. Good day. Yes, Ashok ji.